Market pricing is fundamentally a translation problem. A company does not sell its past profits. It sells a decade or more of future promises. The stock market's structural purpose is to take a stream of cash that has not yet occurred, cash flow in year 1, year 5, or year 15, and compress it into a single present-day price. This compression machine is the discount mechanism, and its output is the intrinsic value, what a future dollar is worth once time and risk are subtracted. The mechanical process involves taking a projected cash flow and dividing it by the sum of 1 plus the discount rate raised to the number of periods until that cash is received. This mathematical operation, when summed across a company's forecastable life and added to a terminal value, defines the price a rational buyer should pay today. The discount rate itself consists of 3 components: the risk-free rate derived from treasury curves, the equity risk premium for market volatility, and a beta adjustment for company-specific swings. A significant misconception among retail investors is treating price as a fixed fact while focusing solely on growth. While investors debate revenue percentages, they often ignore the discount rate, which is frequently the dominant force in the valuation equation. For example, during the 2022 rate hike cycle, growth stock multiples compressed significantly even as earnings climbed. A stock trading at 35 times earnings can lose over 30% of its value if the market-demanded multiple drops to 20 times, simply because the price of time became more expensive. The business did not deteriorate. Rather, the mathematical denominator increased. Understanding this arithmetic is essential, as the discount rate can overwhelm even spectacular operational performance. The discount mechanism functions as a distributed calculation performed continuously by institutional actors. While sell-side analysts build explicit models, the market as a whole reverse engineers these rates through pricing machinery. The clearest evidence of this exists in the bond market. Rather than solving for price using a rate, bond markets take the price investors pay for known coupons and back out the implied discount rate, known as the yield. Consequently, every move in Treasury yields represents a real-time shift in the market's collectively agreed discount rate, forcing every equity on the exchange to reprice against that moving baseline. When uncertainty spikes, market makers widen spreads because uncertainty is the raw material the discount rate is designed to price. This systemic friction is measured through duration. A cash flow arriving next quarter is relatively insensitive to discount rate changes, but a cash flow expected in 12 years is impacted heavily due to the compounding effect of the formula's exponent. This explains why growth stocks are classified as long-duration assets. When interest rates are low, distant cash flows appear attractive. However, when rates rise, those identical future dollars lose significant value in today's terms. Sophisticated capital treats the discount rate as a tradable variable rather than a fixed input. Institutional desks often maintain models of the market's implied discount rate to identify if the broad market is mispriced relative to history. They leverage a temporal edge, updating their discount rate assumptions the moment Treasury yields move, often minutes before retail capital recognizes the shift. This gap between the risk-free rate movement and retail awareness is where institutional alpha is generated, specifically within growth and momentum strategies where duration sensitivity is highest.
Systemic vulnerability in the discount mechanism is often exposed during rate shocks. A recent example occurred in late June 2026 when a 4-session NASDAQ losing streak was triggered not by a decline in AI's commercial prospects, but by a repricing of long-duration growth stocks. Megacaps like Nvidia, Alphabet, and Microsoft, which price in earnings far into the future, saw valuations compress as inflation data raised rate hike probabilities. This fracture point demonstrates that a stock's valuation can break without an earnings miss or a scandal. It only requires the market to revise the rate used to discount distant promises. The Federal Reserve controls the primary input for this, the risk-free rate. Between early 2022 and late October of that year, the 10-year U.S. Treasury yield rose from 1.51% to 4.05%. This forced every equity valuation to be discounted more aggressively. causing substantial compression across all sectors. The transmission between bond and equity markets is nearly instantaneous because both share this architecture. Rising rates make equities structurally less attractive compared to fixed income, prompting widespread valuation compression. Sector rotation, such as moving from growth into value or infrastructure, is often just capital fleeing duration exposure to avoid the compounding bite of higher rates. For the serious investor, the edge lies in distinguishing between a business event and a valuation event. Empirical research using the Gordon Growth Framework suggests that while rates matter, long-run growth expectations often drive major downturns even more significantly. The market frequently conflates these factors, creating mispricings. A rational investor recognizes that a rate-driven sell-off offers an opportunity to acquire the same cash flows at a more favorable price. The market does not price companies, it prices the arrival time of their cash, and the rate charged for waiting is the entire game.